operating activities. So we'll start from that and we'll make adjustments for all that didn't happen in cash. So net income for the year, that's $350. Now, when we're looking at the calculations of net income, we have a few non-cash items here. So that's our first adjustment. So looking at this, what are the non-cash items that we can identify? Sales less COGS, that's cash. Selling is cash. G&A is cash, goes out in cash. Do you pay out depreciation in cash? No, you don't. So that's a non-cash item. So that's an adjustment 1 on your indirect method. Interest, that again goes out in cash. Equity in earnings, is it earned in cash? No, we get dividends in cash. Equity in earnings, that's all the investee has earned, even if they haven't paid out the dividends. So this one is a non-cash item, our adjustment number 1. Gain on sale of available for sale. So when you're selling available for sale, you're getting all the cash. So that's a cash item. Tax again is a cash item. So adjustment number 1, identify the non-cash items. Adjustment number 2, identify the non-operating items. What doesn't go on the operating activity section? So the gain on sale or available for sale securities here, that goes in investing, not operating. So that's a second adjustment. So if you have a gain or loss on sale of PP&E, that again goes in investing. That's not operating. So we're going to identify all that. What we'll do is all these items, now we'll take it out of net income. So guys, we'll start with net income and we'll make an adjustment. We will say this depreciation, the cash didn't go out. So we're going to add back 125 to 350. So this was a subtract here. We're going to add it back. Looking at equity in earnings, we didn't get that in cash. So we're going to subtract it from here. When I'm looking at gain on sale of available for sale securities, that's going to go in investing activities. And that's an add here. So we're going to subtract it down here. So let's do both these adjustments and I'll talk about the third adjustment after that. So adjustment number 1, we're looking at depreciation expense and we're looking at equity in earnings. Depreciation expense was $125, which never happened. So you got to add it back. So it'll increase the net income here. Equity in earnings. Now we saw that the investment account also increased by $25. So ideally there was no dividends coming in. All that was earned by the investee but not paid out. But that increased the net income number. Now we need to reduce it. So if I say this is the debit, this is the credit, I'm reducing the net income number. I'm reducing it by $25. Now, next, we're looking at the second adjustment. Second adjustment is for available for sale securities, gain on sale, which goes on investing. So, gain on sale of AFS. Now, this was a $25 gain, which should not come under operating activities. It will come in number 2, investing activities. So here we'll have $25 reduction of the net income. Now, let's do the T accounts, couple of T accounts for investment, equity, and accumulated depreciation. Okay, we'll do that later. Now, along with that, let's go back. We have a lot of balance sheet account changes for the year. Now, when you start from a net income, this is computed on the accrual basis. Now, you need to make adjustments for those changes in accrual basis accounts. The way we'll do it is we'll try to create T accounts for all changes that are given to us. And then we'll make adjustments. So guys, this is your adjustment number 3. Come back there. So adjustment number 1, you're looking at non-cash items. Adjustment number 2, you're looking at non-operating items. Adjustment number 3, Here you're looking at all the changes in the balances of accrual accounts. So we have a lot of changes in balances given to us. Let's draw all of that. So you have change in accounts receivable, and it's given that that change is $200 increase. That's a $200 debit. So there'll be a lot of stuff on the debit and the credit, but the net increase is $200 for accounts receivable. Then you have inventory. For inventory, you have net increase 75. Increase means debit for inventory. Next, you have accounts payable. So draw the T account and it's increased by 50. So increased by 50 means it'll be a credit here, 50. Increase in allowance for uncollectibles, allowance for uncollectibles. An increase in that allowance means you're going to have a credit of 50. Allowance is a credit account. Increase means credit 50. Then you have accumulated depreciation. Now that increased by $125. You have decrease in bond discount. Bond discount, that was a debit number. Decrease generally by amortization is $15 here. Then you have increase in investment under the equity method. Investment, we're looking at the equity method investment. And that increased by $25. Then you have decrease in deferred tax liability, and that was $25. Liability, that's a credit account. A decrease in liability means debit, 25. Then you have increase in taxes payable. So tax payable, liability, increase in liability means credit, 100. So guys, now you got all these T accounts in place. So these are all the balance sheet changes that have happened during the year. Now what we'll do is, we'll look at what are those T accounts that we've already considered. So I could say this depreciation expense, this is 1A. Equity in earnings, this is 1B. Depreciation expense, 125. Accumulated depreciation. Now naturally, the moment you have depreciation expense, accumulated depreciation, that would increase. So this is done. Now we got the reason why it's increased. Equity in earnings, that's 25. Now we know that investment under the equity method, that's increased by 25. So naturally, all the earnings that is there in equity in earnings is not collected in cash. It's earned by the investee, but cash didn't come in. So this 25 debit becomes a 25 credit here, and this is